which makes reading, holding a book, or turning a page difficult or impossible. The content is copyrighted by the respective publishers. For more information, please visit us on the web at nfradioreading.org.
Hello, this is Dasha, and for the next hour I'll be reading from the Friday, April 3rd issue of the Wall Street Journal on the Niagara Frontier Radio Reading Service. On the front page today, we have Investors Fueling Private Credit Flee to Exit by Anna Maria Andreatis and Peter Rudiger. The rush of individual investors trying to pull their money from private credit funds intensified this week, hitting unprecedented levels and raising the specter of prolonged pressure on the firms that had become the new kings of Wall Street. Blue Owl, once the poster child for the explosion of private credit lenders that fundraised from wealthy individuals, revealed on Thursday that investors sought to pull $5.4 billion from a pair of its funds during the first quarter. The redemption requests amounted to 22% of its $36 billion private credit fund and 41% of a technology-focused fund. It comes after weeks of elevated redemption figures trickling out from competitors, including Apollo, Blackstone, BlackRock, and Cliffwater. Each saw funds receive requests of more than 5% of shares outstanding, the threshold at which most funds limit redemptions. In total, investors have now asked to pull nearly $14 billion in the first quarter from the type of private credit funds known as business development companies that make loans to mostly junk-rated companies, according to investment bank Robert J. Stanger and Company. Investors were able to redeem roughly half that. The redemption requests are up from $5.7 billion in the prior quarter and $3.7 billion in all of 2024. The pool of individual investors that acted as a catalyst for private credit firms' rapid growth are now a source of fragility. Adding to the industry's problems are signs of deterioration on the loans that private credit firms originated in recent years. For now, executives of the major private credit firms are saying that the structures of their funds, which require shareholders to cash out slowly over time, are functioning as intended. They also said that institutional investors haven't shown signs of withdrawing from the asset class. The industry raised $43 billion in fresh capital last year, though those inflows have also been slowing in recent months, Stanger data show. These companies, they're like a shark. They have to keep moving, said Christopher Whalen of credit markets research and advisory firm Whalen Global Advisors. If the market says we've had enough, we're not going to give you any more money. They have to shrink, particularly if you're facing redemption from investors. Analysts said elevated redemptions are expected to continue for several quarters. If fundraising stalls simultaneously, that could prompt a liquidity crisis and force fund managers to use their cash reserves, borrow money, or sell assets to pay shareholders out and satisfy their own lenders. Morgan Stanley analysts laid out a dour future for the industry in a new report Thursday, saying they expect loan defaults to increase, fundraising to be sluggish, and returns to disappoint. In a nutshell, we think risks in private credit are significant, the analysts wrote. The uncertainty has dented all of the lenders' shares, with those of Blue Owl down 43% and Ares Management down 37% year-to-date. Those of Apollo and Blackstone are both down around 26% over the same period. Investor redemptions in private credit funds significantly picked up during the fourth quarter last year, following the bankruptcies of auto parts company First Brands and subprime auto lender Tricolor. Neither were big private credit borrowers, but investors started to wonder whether there could be looming problems in funds they had invested in. Meanwhile, the subset of private credit funds known as BDCs were already reporting that they were accepting more deferred interest payments on outstanding loans. Within the BDCs that Fitch tracks, such deferrals accounted on average for 8% of their interest and dividend income in 2025, compared with 4% in 2019. That increase added to investor concern about the quality of the underwriting. Then, advances in artificial intelligence models called into question the health of the software companies, whose businesses could be threatened by them. Many private credit funds are major lenders to the software sector, leading investors to question whether the funds will take losses on their loans. Fund performance has started to suffer too, including at the two Blue Owl funds hit with high redemption requests. Blue Owl Credit Income posted a 0.8% loss in February, its worst month since 2022. Blue Owl Technology Income posted a 2.3% loss in February, its worst ever month. The lesson that many investors in private credit funds are taking from the limited redemptions that fund managers have honored in recent weeks is to ask for more of their money back than they would have otherwise, knowing only a portion of their requests is likely to be met. There's this huge game theory incentive to be the first one to leave versus stick around, even if you think the fundamentals are fine, said Brian Jacobs, a portfolio manager at Aptus Capital Advisors. Fund managers continue to tout the resources they have to manage through the change in investor sentiment. We continue to observe a meaningful disconnect between the public dialogue on private credit and the underlying trends in our portfolio, Blue Owl executives wrote in a letter to fund investors Thursday. While we believe the market perception has driven elevated tender activity, underlying credit fundamentals across our portfolio have remained resilient. Some of the firms, like Cliffwater, do little investing beyond private credit. The biggest publicly traded private equity firms have all reoriented their businesses around the rapid rise in private lending. At Apollo, one of the earliest to see the opportunity in lending where banks cannot, credit accounts for 85% of the firm's total fee-paying assets under management and 73% of its 2025 management fees. The outflows from private credit funds aren't large enough to dent the profits of asset managers, at least not yet. For instance, the Blue Owl funds that saw outsized redemption requests this week account for 12.5% of the overall firm's fee-paying assets under management and less than 2.5% of annualized outflows, according to Evercore ISI analyst Glenn Shore. In another front-page article by Gavin Bade and Xavier Martinez, the U.S. will impose tariffs of up to 100% on branded pharmaceuticals, the White House said Thursday, though nations or drug makers that strike deals with the Trump administration or commit to build manufacturing facilities in the U.S. can receive lower levies. The 100% tariff will apply to patented imported pharmaceuticals from companies that haven't committed to invest in the U.S. and haven't entered into most favored nation agreements to match their U.S. prices to the lowest they charge in other developed countries, a senior administration official said on Thursday. But the full 100% tariff might apply to only a few drug makers, or none at all. If a company pledges to invest in U.S. drug manufacturing in the coming years, its tariff rate will fall to 20%, the senior administration official said. The company would have to complete the factory by the end of President Trump's term in the White House, the official said, or tariffs could be increased. Additionally, if a company that has made U.S. manufacturing pledge also strikes a most favored nation agreement with the Trump administration, its tariffs can fall to zero, the official said. The tariffs will be effective in 120 days, the official said, during which time large pharmaceutical companies can commit to invest in the U.S. or make MFN deals. Smaller companies will be given 180 days to make investment commitments. MFN deals have been announced by all but one of the major drug makers the administration sent letters to last summer demanding lower prices, and the senior administration official said he didn't anticipate that any drug maker would ultimately face the 100% tariff. Regeneron, the lone holdout, expects to announce a major most favored nation deal soon and anticipates it will be exempt from the tariffs, according to a spokeswoman for the company. Outside the manufacturing commitments and MFN deals, some nations will receive lower pharmaceutical tariff rates based on previous trade agreements their governments struck with the U.S. The European Union, Japan, South Korea, and Switzerland will be subject to 15% tariffs on their pharmaceuticals, while the UK's will be 10%. Companies from those nations can also lower their tariffs to zero with domestic manufacturing commitments. On Thursday, the UK government said its pharmaceutical companies wouldn't be tariffed, an assertion the Trump official confirmed, saying that UK drug makers had already committed to invest in the US. The pharmaceutical tariffs will be imposed under Section 232 of the Trade Expansion Act of 1962, which allows the president to levy tariffs to address national security risks. Those are separate from Trump's so-called reciprocal tariffs, which the Supreme Court struck down in February, and the 10% global tariff that Trump imposed to replace the invalidated levies. The announcement concludes months of deliberations in the administration over how to tariff foreign-made medicines with the aim of moving the manufacturing of cutting-edge drugs back to the U.S. Last year, the Wall Street Journal reported the administration would exclude generic drugs from the pharmaceutical tariffs after months of internal debate, a detail confirmed by the announcement on Thursday. The biotechnology industry's main trade group warned that tariffs would hurt smaller drug developers, which often lack the capital to build dedicated U.S. manufacturing facilities. U.S. biotech companies have been eager to expand investments here at home, but tariffs, along with an uncertain policy environment and efforts to force most favored nation schemes, work directly against that goal, said John Crowley, president of the Biotechnology Innovation Organization. In an article by Ryan Felton, U.S. regulators are weighing a ban on airbag parts from a Chinese supplier after finding the parts were to blame for 10 deaths in a dozen crashes over the past 3 years. Our initial investigation into the use of illegal Chinese airbags in auto shops has revealed a disturbing trend. These substandard parts are killing American families, Transportation Secretary Sean Duffy said. The National Highway Traffic Safety Administration said Thursday it is escalating its probe into airbag inflators from China-based Jilin Province Detianu Safety Technology, known as DTN airbag. The auto safety regulator said it believes DTN's inflators are defective and is considering a ban on their sale in the U.S. The decision is the latest effort by NHTSA to clamp down on a trend of crashes in which DTN's parts have been found to rupture and shower occupants with metal fragments in survivable crashes. NHTSA opened an investigation into DTN in October, and it has been trying to assess how many cars contain the company's airbag parts. The parts typically are found on the secondary market, installed into used vehicles after the airbag deployed in previous crashes. NHTSA has said it doesn't believe any automakers use DTN inflators in new cars or as authentic replacements for vehicles sold and serviced in the U.S. NHTSA said it believes the parts were likely imported illegally. The agency has also launched a dedicated resource page about the airbag parts. It estimates as few as 10,000 might be on the road. In January, NHTSA issued a warning to all used car owners in the U.S., telling them to try to get to the bottom of their vehicles' maintenance histories. Producers of the airbags in the U.S. have purchased parts online and received them in the mail before assembling them in America and selling them as complete airbag modules to mechanic shops online. A statement on DTN's website says the company doesn't do business in the U.S. and that its products are prohibited from being sold to the U.S. An American lawyer who had said he represented DTN didn't respond to a request for comment. The lawyer told the Wall Street Journal in October that DTN is committed to cooperating with NHTSA. DTN has said its business is limited to inflators and doesn't produce airbags. Different models and vehicles of airbags require different types of inflators, and it is the purchaser's responsibility to test to ensure the inflator could be safely used in the purchaser's airbag. the company said in a court filing that is part of a suit in a Florida court against the company over a crash in which a DTN inflator exploded. NHTSA said drivers should get their vehicles inspected if they were in a crash with an airbag deployment since 2020 and weren't repaired at a dealership. If a vehicle is found to have a DTN inflator, it shouldn't be driven until the parts are replaced, the agency said, and drivers shouldn't inspect vehicles themselves. You're listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Will Parker writes that Maine is poised to freeze large data center construction, which would make it the first state to enact such a measure as communities across the U.S. grapple with fallout from the boom in artificial intelligence. The Maine bill calls for a ban on major new data center construction until November 2027, so the state can assess the impact of such development on the environment and electricity grid. The freeze would apply to data center projects of at least 20 megawatts, which is enough energy to power more than 15,000 homes. The bill passed a floor vote in the Democratic-controlled Maine House of Representatives in March, collecting a handful of Republican votes. It is expected to pass in the Senate, which is also majority Democratic. Governor Janet Mills said she supports a freeze. Maine has some of the country's highest residential electricity prices, and elected officials are concerned that a surge in data center power demand might further inflate costs. The AI build-out is driving up electricity costs for consumers in some parts of the country and, at the same time, generating large tax revenues for local governments that continue to court developers. The bill's momentum will be closely watched by lawmakers in at least 10 other states that are advancing similar policies over concerns about straining local power sources and the cost. The effects of the artificial intelligence race on the economy, energy costs, and the environment is emerging as a major issue ahead of this year's midterm elections. In Maine, a U.S. Senate seat is up for grabs in November. I think Maine is the canary in the coal mine, said Anirban Basu, chief economist for the Associated Builders and Contractors, a construction trade group that counts members who work on data centers. Maine will be the first of many states to have such moratoria. Legislators have introduced measures to temporarily ban or restrict data centers in New York, South Carolina, Oklahoma, and other states. In Ohio, one of the top states for data center development, a group of rural activists is collecting signatures to put a statewide ban of large data centers on a November ballot. Many other municipalities and countries, especially small ones in Michigan and Indiana, already have imposed their own temporary pauses. Denver and Detroit are among major cities considering such bans. Data center developers are growing increasingly wary of community and political opposition as they hunt for powered land across the country. Proposed local laws restricting data centers are a red flag, said Tracy Hyatt Bossman, a site selection consultant at BLS and Company, who works with data center developers. They do limit where we are looking, she said. Tony McDonald, who is developing a data center in the western Maine town of Jay, said he's scheduled to begin construction in July. All of a sudden, we've been caught in this dragnet, he said. Maine hasn't been a magnet for Alphabet's Google, Microsoft, or other companies building hyperscale facilities for artificial intelligence. Recent data center proposals in the Maine towns of Wiscasset and Lewiston were paused or failed at the local level following resident opposition. Some data center developments in Maine have targeted defunct industrial sites, such as closed mills. One company recently proposed to build a $415 million underwater data center off Maine's coast. While it is possible the Maine moratorium bill could stumble in the amendment process, that a version of it eventually becomes law is a foregone conclusion among some state political operatives. That's the political reality, said Tony Buxton, a climate and energy attorney at Pretty Flaherty, a legal and lobbying firm in Maine. There's a very strong voter fear of data centers and AI. Buxton's firm has placed ads on social media advocating exemptions in the bill that would allow two already planned data center projects to move forward in Jay and in Sanford, which is in the southern Maine. These exemptions are being considered in the House. Governor Mills, a Democrat who is running for the U.S. Senate, said she supports the data moratorium if it includes an exception for the J project. On the opinion page, under Review and Outlook, Trump's breakthrough defense budget. Washington has for years given priority to spending on butter over guns. The result is a shrunken military-industrial base that has been exposed by the wars in Iran and Ukraine. Credit then to President Trump, who is meeting the moment by proposing a new and record increase in national defense. The White House releases its fiscal year 2027 budget on Friday, and we got an early look. Most noteworthy is its proposal to boost defense spending to $1.5 trillion. This includes a $250 billion increase in the annual defense baseline from $903 billion, plus $350 billion in supplemental funding that Republicans could pass in a party-line budget reconciliation bill. Defense spending in 2027 would be roughly double what it was in 2021 and more than 40% higher than this year, including the supplemental $155 billion that Congress provided in last summer's bill. Defense spending has fallen to 3% as a share of GDP, compared to some 6% in the 1980s and 8% in the 1960s. The White House budget would increase this to 4.5%, which is close to the 5% goal the president set for NATO members. The rub will be sustaining this defense commitment as entitlements grow on autopilot and grab an ever larger budget share. Spending on defense made up about 13% of total federal outlays in 2025, half as much as in the 1980s and 70% less than in the 1960s. Joe Biden sought to continue this declinist trajectory with a 2025 budget that proposed $9.7 trillion in defense spending and $10.4 trillion in non-defense spending over 10 years. The Trump budget shifts the government's priorities in the right direction, with $13.5 trillion in defense and $6 trillion in non-defense spending over the next decade. The budget includes $65.8 billion to buy 18 Navy warships and 16 non-battle force vessels. The Office of Management and Budget says the administration has requested funding for 123 vessels for all agencies, including the Coast Guard, across its two budgets and the supplemental funding bill, which is the largest shipbuilding order since World War II. This is needed as the current fleet is working overtime and is too small to meet America's far-flung obligations. The U.S. in recent years has retired more warships than it's commissioned. Many older ships can't be deployed because they need repairs. This means vessels are doing double duty with increasing risk of breakdowns. A fire broke out last month on the aircraft carrier USS Gerald R. Ford, which has been sailing around the world for nearly 10 months, a near-record deployment. For those that are not in the Navy, that's an extraordinary thing to even think about something of that kind of deployment length, Chief of Naval Operations Admiral Darrell Caudell said this weekend. The new Trump proposal also aims to expand the military-industrial base so that the U.S. won't have to worry about being short of munitions or manpower. This includes long-term contracts to replenish munition stocks so defense contractors can invest in production lines with more certainty. The budget recommends a 5% to 7% pay increase for military personnel next year, and it includes critical investments in the Golden Dome missile defense system, the sixth-generation F-47 stealth fighter program, new drone models, cruise missiles, and long-range fires crucial to defending Taiwan. Congress will get the final say over how much of this becomes law, and Mr. Trump will have to keep the political pressure on. Deficit scolds will say it's unaffordable, but there are savings to be had by cutting fraud in Medicaid and other welfare programs. Investing in military deterrence is also far cheaper than having to fight a war against China. Mr. Trump likes to say, no military can match America's. Yet it isn't nearly as dominant as it once was, even as the world grows more dangerous. The president's budget shows a welcome new realism about the multiplying threats America faces. Pam Bondi gets beached as AG. Is there a worse job in Washington, D.C. than Attorney General under President Trump? We can't think of many. And on Thursday, Pam Bondi learned this the hard way as the president sacked her after only 14 months on the job. Ms. Bondi won't go down as a great AG, but we wonder if anyone could succeed given Mr. Trump's expectations for the job. The president wants someone who will do his bidding, which is proper on policy issues. The problem is he also wants an AG who will indict his political enemies and stretch the limits of the law to serve his political goals. This is a losing proposition. Ms. Bondi's great fault is that she was never good at saying no. She blundered on the Epstein files by boasting about big revelations that never materialized. This fed the conspiracists who fretted about a cover-up. A manageable problem turned into a political fiasco that has hurt the president. She also kept trying to appoint U.S. attorneys who hadn't been confirmed by the Senate and were ultimately rejected by the courts. She presided over indictments of James Comey and Letitia James that judges dismissed. Mr. Trump may have appointed Ms. Bondi, a former Florida AG, because he thought she'd be a yes woman, but this hasn't served him well as his second term has unfolded. We don't subscribe to the view that the Attorney General is independent of the President. This nostrum common on the left, at least when Republicans hold the White House. The AG reports to an elected president, but a good AG owes the president his best independent legal advice, even if it's something the boss doesn't want to hear. This is the role that Bill Barr played in Mr. Trump's first term and is a model for what an AG should be. Mr. Barr took the hits for the president as he insisted the Mueller report on Russia collusion be adequately scrubbed before it was released. He defended this and other decisions and stood up to criticism in a way that Ms. Bondi didn't with the Epstein files. Mr. Trump grew frustrated with Mr. Barr at the end of his first term when the AG concluded there wasn't real proof of fraud to overturn the 2020 election results. And that is why Mr. Trump may find it hard to find someone like Mr. Barr to replace Ms. Bondi. Jeanine Pirro, the U.S. Attorney for the District of Columbia, would be another yes woman. She sent a criminal subpoena to Federal Reserve Chairman Jerome Powell without evidence of a crime after Mr. Trump attacked the Fed chief. She'd have trouble getting through the Senate. A good choice would be Jay Clayton, the U.S. Attorney for the Southern District of New York and former chairman of the Securities and Exchange Commission. He's a savvy political player with allies in the Senate as well as the backbone to tell the president when he's stretching the law. The president's use of lawfare to repay his enemies will backfire on him, as it did on Democrats in 2024. He needs an AG willing to tell him when his demands cross a legal line. There's an opinion piece by Bernie Sanders, the independent U.S. Senator from Vermont, as we continue to read articles and features from the Wall Street Journal on the Niagara Frontier radio reading service. AI is a threat to everything the American people hold dear. The American people are deeply apprehensive about the impact that artificial intelligence will have on their lives. A recent Quinnipiac poll found that 55% of Americans think AI will do more harm than good. 70% think AI will lead to fewer jobs, and only 5% think AI development is being led by people and organizations that represent their interests. In the midst of all this deep concern about the future of AI, 74% of Americans think the government isn't doing enough to regulate the use of AI. 65% of Americans oppose the construction of new data centers in their community. The American people understand that AI and robotics will transform our world. They want to make certain that this technological revolution makes life better, not worse, for them and their families. They know that fundamental questions must be answered before we rush forward. They don't trust the AI oligarchs. At a time of massive income and wealth inequality, people recognize the AI revolution is being led by some of the wealthiest people in this country. Billionaires like Elon Musk, Jeff Bezos, Mark Zuckerberg, and Larry Ellison are investing enormous sums in AI and robotics, not to improve life for working families, but to expand their own wealth and power. How can we rush forward when AI could displace tens of millions of workers? Elon Musk has stated that, quote, AI and robots will replace all jobs, end quote. Bill Gates has said humans won't be needed, quote, for most things, end quote. If machines can perform most economically valuable work better than humans can, how do people earn a living and support their families? It isn't only the economy. How can we rush forward when AI is already reshaping how we as human beings relate to one another? According to a recent poll by Common Sense Media, 72% of all U.S. teenagers say they have used AI companions, and more than half do so regularly. What does it mean for young people to form friendships with AI while becoming lonelier and more isolated from other human beings? How can we rush forward when AI threatens our privacy as we know it? For decades, companies have been collecting our personal information. AI now makes it possible to analyze that information at unprecedented speed and scale. Larry Ellison predicts an AI-powered surveillance state in which, quote, citizens will be on their best behavior because we're constantly recording and reporting everything that's going on, end quote. How can we rush forward when AI is undermining our democracy? The rise of deep fakes, convincing fake images, videos, and audio makes it possible for bad actors to distort what elected officials and candidates are saying. If people can't trust what they say and hear, informed decision-making becomes nearly impossible. How can we rush forward when AI is driving up electric bills, diverting scarce water, and damaging the environment? Meta is building a data center in Louisiana, nearly the size of Manhattan, that will use as much electricity as 1.6 million homes. Data centers will deepen our reliance on fossil fuels during a climate crisis. How can we rush forward when leading scientists warn that AI poses an existential risk to the human race? Geoffrey Hinton, the Nobel Prize-winning godfather of AI, warns there is a real chance AI could wipe out humanity. Yoshua Bengio, the most cited living scientist in the world, says we're playing with fire, and we still don't know how to make sure the machines won't turn against us. They're not alone. In 2023, more than 1,000 AI experts, including Elon Musk, called for AI labs to, quote, immediately pause for at least 6 months, and if they don't, on governments to step in and institute a moratorium. So why hasn't Congress taken any meaningful action to regulate artificial intelligence? The answer isn't complicated. The AI industry has already spent more than $185 million to make sure government does nothing to protect the American people. We can't allow a handful of billionaires eager to increase their wealth and power to rush forward with technology that will fundamentally transform humanity without democratic input or accountability. Congress must act. That is why I have introduced legislation with Representative Alexandria Ocasio-Cortez to impose a federal moratorium on the construction of new AI data centers until strong national safeguards are in place. A moratorium will give us time to ensure AI is safe and effective, time to protect our privacy and well-being, time to defend our democracy, and time to make sure the economic gains of this technology benefit the general population, not just a handful of billionaires. The future of AI must be decided by the American people. In the business and finance section, on the front page of it, OpenAI acquires streaming talk show by Katie Dayton. OpenAI is getting into the business of daily news. The maker of ChatGPT said it has acquired TBPN, an online talk show that aims to compete with Bloomberg and CNBC in by-the-minute analysis of technology news and executive interviews. OpenAI declined to disclose the terms of the transaction. While TPBN's audience remains modest, averaging around 70,000 viewers per episode across various online platforms, the show has become popular among Silicon Valley power players who consider it more supportive of their industry than traditional news outlets. Chief executives who have appeared as guests include Meta Platforms' Mark Zuckerberg, Microsoft's Satya Nadella, and OpenAI's Sam Altman. The 11-person company which launched in October 2024 and began live streaming for 3 hours each weekday in March 2025, says it is profitable and that it generated around $5 million in revenue from advertising last year. TBPN was on track to make more than $30 million in revenue in 2026, according to the company. OpenAI bought TBPN to encourage constructive conversation around the changes AI creates by helping the show to grow, according to a memo sent by Fidji Simo, the OpenAI's CEO of applications. TBPN will report to Chris Lehane, OpenAI's Chief Global Affairs Officer, and will help with company communications and marketing outside of the show. They've helped many brands market online, and because they have a strong pulse on where the industry is going, their comms and marketing ideas have really impressed me, Seymour wrote in the memo. But TBPN will remain editorially independent, retaining control over its programming, editorial decisions, guest selection, and production scheduling, OpenAI said. Corporate promises of editorial independence have been tested by business interests before, as staff at crypto news site CoinDesk alleged in 2024, when the crypto exchange that owns it ordered an article removed. Whether the new ownership affects how TBPN is perceived among key audiences, including OpenAI rivals, remains to be seen. There's more on this story. If you want more of it read to you to finish, you can please call our station at 716-821-5555, and staff will be happy to read it to you. Digital stock avatars are coming to the U.S. by Vicky Gay Huang and Hannah Miao. While Hong Kong slept, Leo Lee was buying Google. In the early hours of March 25th, Lee bought a slug of digital tokens that represented about 6,940 shares of Alphabet, Google's corporate parent. The full-time investors' trade, placed on the tokenized security platform Ondo Global Markets, was executed in seconds, just past 1 a.m. local time. On this night and most others, Lee monitors the market from his Hong Kong home office, where he manages a traditional stock portfolio alongside a $6 million basket of tokens linked to shares of the Magnificent Seven and a gold fund. He logs off by 4 a.m., then gets a few hours of fragmented sleep before Asian markets open for business. Yeah, there's really no such thing as work-life balance, especially with the Trump situation, where things can head in a dozen different directions in a single day, Lee said. Welcome to the market's tokenized future, where the closing bell never rings and investors can swap quiet weekends for the opportunity to trade through a news cycle that never sleeps. Tokenized equities, essentially digital avatars for stocks, allow people to trade 24/7 and clear those trades in seconds rather than days. U.S. regulators don't permit American investors to own tokenized stocks, but it is allowed in many international markets, and platforms such as Robinhood Markets and Kraken are making tokenized trading available to foreign customers. The U.S. isn't far behind, with the New York Stock Exchange and NASDAQ readying their tokenization platforms. Qualified U.S. investors can already access other tokenized assets, such as money market funds, private funds, and commodities like gold. Many tokenized stocks aren't truly equity, meaning they lack the legal protections and rights conferred to owners of traditional shares. Without enough investors buying and selling those tokens, their prices can deviate significantly from real stocks. Some skeptics have said that professional traders benefit from weekend breaks, adding that 24/7 markets can lead to burnout and diminished decision-making quality. Tokens are still a niche corner, even overseas, and one inhabited mostly by die-hard crypto fans. The total value of all tokenized stocks in circulation stood at just over $900 million, with about 200,000 holders, according to analytics platform RWA.XYZ, compared with trillions of dollars in global stock markets. In their current form, most tokenized stocks are technically derivative contracts that give international investors the price exposure to popular U.S. stocks. Their investors don't receive dividends directly or get to vote on shareholder engagement or other corporate actions. NASDAQ's plan, a pilot program that would allow investors to trade certain high-volume stocks either as traditional shares or as tokens on the blockchain, was recently approved by the Securities and Exchange Commission. The exchange would settle tokenized shares through the Depository Trust and Clearing Corp., which safeguards more than $100 trillion in financial assets and plans later this year to tokenize some of the U.S. Treasuries, for which it serves as custodian. This is no longer driven by FOMO, said Nadine Shakar, global head of digital assets at DTCC. It's truly driven by real business cases, client demands. She added, we are keeping an eye toward the future, where our ambition is to tokenize all $100 trillion in assets that we have. That is the ultimate goal that we're striving for. The 24/7 availability wasn't enough to lure investors to stock tokens during the recent market shocks triggered by the Middle East conflict. Instead, traders flocked to perpetual futures, a type of derivative contract that never expires, to bet on the prices of oil and gold. In recent weekends, oil-linked perpetuals on the crypto exchange Hyperliquid saw billions of dollars in trading volume. The cumulative volume on the exchange's oil futures surged to $22.5 billion as of March 30th, from $339 million on February 28th, according to the crypto data provider Keiko. Tokenization is interesting for asset managers who want to sit on stuff, but for the majority of people on-chain today, they really just want to trade the thing, said Kalidora Kiernan-Lean, a co-founder and chief executive of Ostium Labs, which offers perpetuals linked to traditional assets. For now, traders like Lee offer a glimpse of what is coming to the U.S. and remind investors not to expect a stock market revolution when tokenization arrives. For Lee, the appeal of tokenized stocks isn't their round-the-clock access. In fact, he said, he can only trade them effectively during U.S. market hours when most of the buying and selling occurs. All of that activity helps ensure he gets the best execution, meaning brokers will route his orders to the trading platform offering the best price. Several active token traders said they couldn't care less if their holdings don't pay dividends or give them shareholder rights. And with Bitcoin and other digital assets still reeling from last year's crash, traders are seeking out alternatives that allow them to keep their money on crypto's digital rails. The core advantage for the stock market is, with tokenization, it gains access to a new audience that it could never tap before. It's young, Gen Z, crypto natives, said Vugar Usi, chief operating officer of the crypto exchange MEXC. These people never thought about investing in the stock market. Now there's extra money flowing to the stock market. That is a very huge retail market that is opening up. Lee said tokens work for him because he can buy them with stablecoins, a type of cryptocurrency pegged to the US dollar. With a traditional brokerage or bank account, he said he'd have to sell his crypto and then use government-issued currency to buy stocks. For many crypto investors, this isn't just convenience, it's a genuine necessity, he said. Oil prices post one of the biggest yet daily gains by Ryan December. U.S. oil futures notched their biggest daily gains since they were climbing back from the COVID crash 6 years ago to close out a whiplash holiday-shortened week at $111.54 a barrel. Benchmark oil futures are now up 66% since the U.S. and Israel began bombing Iran at the end of February. In dollar terms, prices in March rose by $43.96 a barrel, more than in any other month since West Texas Intermediate futures began trading in 1983. In 2 trading sessions so far in April, they have added another $10.16 a barrel. Energy futures trading is closed for Good Friday along with the stock market. Futures will resume trading at 6 p.m. Sunday. Oil executives and analysts say that future prices need to climb further before they reflect how expensive actual barrels of crude have become. Some spot market prices around the world are at their highest since 2008, when U.S. futures hit their record of $145.29. That would be around $215 a barrel in today's dollars. Prices had fallen during the two trading sessions leading up to President Trump's primetime address Wednesday night, when he dashed the hopes for a prompt end to the Iran war that had been coursing through markets. Trump vowed to hit Iran extremely hard in the coming weeks and pummel the country back to the Stone Ages where they belong. Thursday's $11.42 a barrel climb was the only third time prompt month oil futures have ever added more than $10 or more in a single session. One was the anomalous $47.64 daily bounce back from negative territory during 2020's COVID lockdown. The other two instances, $16.37 and $10.75, were on the way to the 2008 peak. You're listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. The soap opera at hedge fund Two Sigma has a new plot twist by Peter Rudiger. A vendetta between the billionaire founders of Two Sigma Investments flared up last month, prompting a new leadership battle at their $70 billion hedge fund firm. John Overdeck and David Siegel have been feuding for years at the quant trading powerhouse they started 25 years ago. In August 2024, they stepped down as co-chief executives after their fights had reached a point that Two Sigma couldn't make key decisions about management and governance, the Wall Street Journal previously reported. Trying to insulate Two Sigma from their strife, they settled on a new leadership structure by which each of them got to name one member to the firm's two-person management committee. Overdeck chose a Two Sigma veteran, Carter Lyons, and Siegel selected a former Lazard executive, Scott Hoffman. The two picks were named co-CEOs, while Overdeck and Siegel remained Two Sigma's principal owners and co-chairmen, maintaining indirect control over the firm. That fix has broken down. First, Overdeck last year retook Lyons' seat on the management committee, though Lyons remained co-CEO. Then last month, Hoffman resigned, citing ongoing governance challenges since Mr. Overdeck's return, according to a regulatory filing this week. Siegel designated Seth Platt, a former executive at activist hedge fund firm Sarissa Capital, to take Hoffman's spot on the management committee. Platt moved to fire Lyons, given his view that the current co-CEO undermined his authority, according to the filing. Overdeck stepped in to halt Lyons' dismissal, which he viewed as imprudent and baseless, and insisted it go to a dispute resolution process, the filing said. There's a question over whether Platt's appointment automatically made him the co-CEO and gave him the authority to fire Lyons, the filing said. We are grateful to Scott for his contributions to Two Sigma and excited to welcome Seth, who brings nearly 3 decades of investment management experience to the firm, a Two Sigma spokesperson said in an email. We are focusing on sustaining our positive momentum and providing differentiated returns for our investors. Before stepping down as co-CEOs, Overdeck and Siegel rarely appeared together at firm events and frequently sniped at each other in meetings, the Journal previously reported. Two Sigma's original operating agreement stipulated the duo had to agree on key decisions. Even after the 2024 pact, Overdeck and Siegel quarreled over whether either of them breached their contracts or fiduciary duties, a fight that went into arbitration last year. All claims and counterclaims were dismissed, the filing said. Arbitrators declined to award any relief and found that Overdeck's and Siegel's over-the-top efforts to assert claims against each other hurt their credibility. Despite Two Sigma's undeniable success, the co-chairman's ongoing disputes and differing views on corporate governance have caused management dysfunction, the arbitration panel found, according to the filing. Overdeck, a mathematician, and Siegel, a computer scientist, met while working at quant hedge fund pioneer D.E. Shaw Group in the 1990s and founded Two Sigma in 2001. The firm uses computer-driven strategies to trade based on patterns and signals it sniffs out in markets and big data sets. So far, investors have focused more on the firm's strong performance than on the infighting. Its absolute return enhanced fund gained about 3% in March and is up 3.7% so far this year, a person familiar with the matter said. Its Spectrum fund gained 3.1% in the first quarter, the person added. Our investment strategies continue to deliver strong, consistent performance. Assets under management remain at record levels, and we are investing in our people and our pattern and our platform, the Two Sigma spokesperson said. Returning to the opinions page, Ben Apple, the author of Cis White Gay, The Making of a Gender Heretic, has written, "I'm gay, but that doesn't make me queer." I was 29 in 2012 when I volunteered for Maryland's marriage equality campaign. That November, my home state became one of the first in the country to legalize same-sex marriage by popular vote. I was euphoric and hungry. I wanted to keep chasing the feeling that came from being on the right side of a righteous cause. 2 years later, I got married. At the time, I was working as a hairstylist, a career I'd fallen into after dropping out of college in my early 20s. One night over dinner, I admitted to my husband that I felt stalled. If I wanted to do serious work on behalf of gay people, I needed more than slogans and passion. I needed an education. With his encouragement, I enrolled in a community college. A year later, I was accepted to Columbia University's School of General Studies. I arrived at Columbia in my 30s with the earnestness of a convert. I enrolled in courses like U.S. lesbian and gay history and Muslim masculinities, absorbing everything my instructors had to say about queerness until I learned what they actually meant by the term. Before Columbia, I would have dismissed right-wing complaints about queer, post-colonial critical race and other critical theories as culture war hysteria. I soon came to understand that in Ivy League humanities classrooms, critical theories aren't fringe ideas, they are foundational ideologies with real-world political ambitions. Critical theory treats moral norms, scientific categories, and even common sense as products of power. It tells us that the only reason we believe certain things are true is because it serves the interests of dominant groups for us to believe them. It follows that liberation requires dismantling inherited forms of knowledge. Queer theory applies this approach to sexuality by framing sexual identity as a site of resistance. One of the earliest readings I encountered was by the theorist David Halperin, who defined queer as whatever is at odds with the normal, the legitimate, the dominant. Once a slur that implied homosexuality was shamefully deviant, queer was reclaimed in the 1980s by gay activists as a synonym for gay. But queer theory rejects that equivalence. Most gay and lesbian Americans seek what minorities have long sought: safety, dignity, stable relationships, and the freedom to live ordinary lives. Queer politics, by contrast, encourages deviation from social norms. Its definition of queer isn't that different from Archie Bunker's. Seen through this lens, contemporary phenomena that appear baffling begin to make sense. The members of Queers for Palestine know that Hamas would imprison or execute them for their sexuality, but they share a common enemy in Israel and America. Liberal democracy, capitalism, national borders, and Enlightenment notions of truth are the primary enemy. Sexual politics is barely one front in a much broader civilizational struggle. I learned all of this at Columbia with growing unease. I was gay. I had faced discrimination. And I had fought for my rights. But now that gay rights had become LGBTQ rights, I found myself teamed with a lot of people whose values were nothing like mine. I didn't experience my life as a rebellion against reality. I didn't want to be an identity insurgent. I wanted to participate in the world as a normal person. The most important thing I learned at Columbia was this: I am gay, but I am not queer. My sexuality doesn't obligate me to embrace a particular ideology or to reject the moral inheritance of the society that made my life possible. Progress happens by acknowledging shared human values and working within our reality rather than declaring war on it. And finally, in Potomac Watch by Kimberly A. Strassel, at the court, Trump courts defeat. Donald Trump on Wednesday became the first sitting president to attend a Supreme Court oral argument, a scene that ranked with some of the best gangster intimidation movie scenes. There he sat in the public gallery, Don Corleone-esque, daring the Supreme Court to find fault with his read on birthright citizenship. All that was missing was a horse's head. Yet as most gangsters find out, intimidation has limits. As often as not, it proves counterproductive. Mr. Trump learned the art of pressure campaigns in business, and at times it serves him in dealing with allies and adversaries. But this frustration-fueled bullying of the justices will get him nothing. It could lose him plenty. That's because there's arguably no president in history who's crafted more of his agenda around the high court. Mr. Trump returned to Washington determined to shake up a moribund political structure that has, in too many ways, been cruising on autopilot since the New Deal. Central to that change is a legal strategy, a smart move given the current court makeup. The president has taken dozens of actions that deliberately challenge the status quo with a clear eye to forcing the courts to reconsider the legal foundations of huge issues or to clarify lingering questions. There are no small concerns. The administration has already persuaded the Supreme Court to repudiate nationwide injunctions. In coming months, the justices will decide whether presidents have authority over independent agencies, potentially ending 90 years of an unaccountable fourth branch. The administration is positioning for an overdue ruling on impoundment, whether the president must spend all the money Congress appropriates. The Progressive Resistance has filed more than 600 lawsuits, teeing up cases that nobody expected to litigate, but the White House is determined to win. Does the president have the authority to fire federal employees or shutter offices within agencies? Can he rescind past presidents? Bans on drilling? Deport accused gang members under the Alien Enemies Act or deploy the National Guard to enforce immigration laws? The outcomes of these cases will play a decisive role in future presidencies, and in ways the plaintiffs may not like. While the justices care not a fig for coddling the president, they do have a deep interest in the reputation of their own institution. And surprise, they're human. It's impossible to imagine any of the conservative justices blatantly ignoring their own legal leanings to rule against Mr. Trump out of pique or to make a point of separation. But many cases are close-run things, and as the wide variety of conservative opinions show, there are often many sound positions and approaches to choose from. Some that the president might like a lot less than others. So go ahead, Mr. President, keep poking. It's only your agenda and legacy on the line. This court hectoring is undoubtedly a function of Mr. Trump's own understanding of how much is at stake. But having come to office with his hyper-aggressive litigation strategy, just proudly own it. Gonna play big? Except that this also means failures. Examples: tariffs were a legal winger, an action with no clear statutory authority that no president had ever attempted before, and they legally bombed. A few other disappointments are also likely coming, say, over the firing of Federal Reserve's Lisa Cook, simply because there are strong arguments on the other side. But that's called high stakes. Move on, especially because that isn't the usual case. For all the left's howling about a lawless president, Mr. Trump surrounds himself with good lawyers. He has over the years won huge cases, his travel ban, presidential immunity injunctions, and continues to. This court has been principled, meaning largely deferential, in allowing many Trump policies to continue while litigation is ongoing. And by the end of his term, he'll likely end up with several key legal victories, if he doesn't get in his own way. That was a shortened version of that article. You've been listening to a reading of articles and features from the Friday, April 3rd issue of Wall Street Journal. We read from the Wall Street Journal every Monday through Thursday at 11 p.m. and Friday at 6 p.m. Your reader has been Dasha. Thank you for listening.
Coming up next in the Niagara Frontier Radio Reading Service, we have a reading of the Buffalo Criterion, followed at 8 o'clock by the New York Times, and at 9 o'clock by Buffalo Spree. Stay with us for these readings and more throughout the day. following program is intended for listeners who are blind, have low vision, or have another print disability, which makes